Hey everybody, this is Jeff, Swing Trade Warrior with WarriorTrading.com, back with our weekly closed swing trade recap video blog. I apologize in advance for my voice. I'm battling a horrible cold that I've had for a few weeks, but other than that, I feel fine. We had a 100% success rate on all trades from this week, and so we're going to talk about the few of those that we did have. For those of you who are watching this on recording, playback, please email me with questions. Jeff@warriortrading.com. Always happy to answer questions from anybody interested in trading, options, swing trading, warrior trading, anything like that. The first trade I want to talk about is one of the earlier trades we closed out in the week, and that was on Apple. Apple, we were in for 6 days. What I liked about Apple when I saw this here, it was pulling back. You can see this red line at the 118 price level represents the resistance that Apple was trading at just a week or so ago. What happened here is I saw this opportunity as a pullback. It was alerted to me by one of our members who thought it was an interesting setup, and I tended to agree. The red line is the top of the TAS market box. I use TAS market profile indicators. The TAS market map is what you see over here on the left, and the TAS boxes are what you see, this red, blue, and green line. The top line here represents an area of resistance. Obviously, you can see price action confirms that the 118 area is significant as far as resistance goes. I did get long on this trade on a pullback here to the midline, which is the 116.90 area, 116.90, 117. We got long on this trade on October 19th, and we held this thing for 6 days, looking for a run-up in earnings, ahead of earnings, possible squeeze, and maybe even a break over this 118 area to get us back to the 120 spot that Apple hasn't traded at for quite some time. Okay, we didn't get the break that we were looking for, but we did get out of the way of the event. You can see the day before the earnings event, this red E down here. Apple ended up being a miss, but we closed out the trade on the 25th. And on this Apple trade, we only locked up a 2% winner. Not the move that we were looking for, but we did manage to make some money on it. Wasn't a loser for us, and we got out of the way before earnings had any impact on our position. All right, so the next trade that we took here was CAT. This was an earnings trade. All right, we used Iron Condor on Caterpillar, looking to capitalize on a flat earnings move. I get emails all the time. People ask me, Jeff, what's an Iron Condor? How do you use an option strategy to trade around earnings? How do you use it as an option strategy to trade around earnings events? Iron Condor, very simply put, is an option strategy. It's a spread where it's a multi-leg spread where we're looking to capitalize on volatility crush. What is volatility crush? Simply put, it is the sudden deflation of implied volatility in option premium pricing following an event. So we know that as stocks approach earnings events, the implied volatility in the options premium price goes up. Because people are anticipating an earnings event to move the stock. It increases the volatility of the stock during that time, and therefore the premiums go up. So what we do is we look to put on two credit spreads, which comprise the wings of the Iron Condor. If you guys have more questions about this, you can go to warriortrading.com/options. You can take a look at what an Iron Condor looks like. But basically, we're looking to capitalize on the volatility crush or the deflation of the volatility after the event. So we look to capitalize on a neutral move. You can use a straddle or a strangle if you're bullish, bearish. If you're not sure which direction the stock's going to go, you think it's going to make a big move, you'd use a straddle or a strangle. If you think that the stock is going to remain relatively flat, then you would use something maybe as like an Iron Condor, where you capitalize on a flat move, a neutral move. The stock doesn't move up or down in a large range, and you're able to capitalize on the deflation of the volatility as the premiums get cheaper, right? So it's a credit spread, very similar to shorting a stock. You sell the premium when it's high, you buy it back when it's lower, and you keep the difference. You can see the earnings here on Caterpillar. Took place on October 25th here, and the move, while Caterpillar has since sold off. The move is relatively flat. You can see that the stock price on the day of earnings made, let's see, total tick range was $3.77, meaning that the stock only had a range from the high to the low of $3.77. So not a big mover, despite the volatility that was in play. We sold a credit spread here on Caterpillar for 45 cents and per contract or per spread, and we bought it back for 20 cents. You held this a little bit longer, you could have probably bought it back for 15, maybe 10 cents, but I always look for 20 to 15 cents as my target. So my order was already out at 20, got filled right away. We locked up 25 cents per spread on this. You take enough contracts and you get paid pretty well. You can see that Caterpillar has sold off since the earnings event. Hasn't really broken this area of significance here at $83. $83 is a pretty big area of support. It was an area of some resistance previously, and now it's acting as support. And you can see this yellow line, which is the TAS market map, telling us that at $83 or just above $83 here, there's an area of contention. That means there's a lot of buying and selling competing volume. The buyers and the sellers are struggling for control here. The shorts are trying to break it down below 83, and the long biased investors are trying to pick it up at 83 for the move back higher. So this 83 area is high volume price range, price area, and you can see that it's indicated by this long yellow line. Moving on to the next trade here would be on Visa. Okay, we traded Visa, another earnings Iron Condor. Same exact concept as on Caterpillar. You can see the earnings event took place on, looks like on 10/24. This red E down here tells us, and let's see here what happened to the stock price. So the day before, the stock closed at 82.35. The day after, the stock closed at 83.17. So less than 50-70 cents higher. You can see that we did get a little gap up here from earnings. It sold off, closed as somewhat of a doji, and there's not a lot of range following the move. And so we were able to capitalize again using a pair of credit spreads, also known as an Iron Condor. We were able to capitalize. Let's see, we sold this to open for 45 cents. We bought this to close for 5 cents. So the move from 45 cents is what we sold it for. We bought it back at 5 cents. It means we kept 40 cents in the premium. It was about 89% or so of that move. That was our profit take here on Visa, which was an Iron Condor through the earnings event because we didn't anticipate any wild move. It tends to be a pretty static trading name during these events, and so we just capitalized on the volatility crusher. That's all we did. CMG. We traded CMG. That was another earnings name. Now this one tends to be a little bit of a wild name. Anybody who follows CMG has seen it put in giant 50, 60, 70 point moves that it's capable of. This thing was trading at nearly $800 just about a year ago, and now it's trading at $370. So this thing's kind of volatile. Earnings event took place on October 25th. And we sold this for a credit spread again for 50 cents here. We took in premium for 50 cents. After the earnings event, this thing did move down. And we locked up, looks like 15 cents is where we bought it back. So we were able to lock up 35 cents on this move here. Or a return, or about 70% of the premium that we sold, or the credit that we got. So we made 35 cents per option contract here. Again, we were looking for, on this particular Iron Condor, we sold the 355 and 465 were our short strikes. 355 and 465. So 465, I'll draw some lines here just to give you guys an idea. 465 is right here, and 365 is right here. Okay, so between these blue lines is where we profit on this trade, and you can see that even though we did dip down here below 365, we haven't really breached it or closed below it. This Stock hasn't traded above or below this blue line in a long time, and especially more importantly since the earnings event. Now, we profit while the stock remains between these two. The volatility crush takes place the day after earnings, or the trading session following earnings. So when this thing reported, the next trading session was when we had our order out to close the position. Again, we sold it for 50 cents. We bought it back for 15 cents, and we locked in the 35-cent profit. And we did this because it stayed between these two price points for the earnings event. So it came close to breaching to the downside. It did not, still hasn't. And it was a good trade. So the reason why I like Iron Condors over straddles or strangles is because straddles or strangles that you put on ahead of an earnings event are generally speaking going to be very, very overpriced. You're going to pay a premium because of that exact same concept that we talked about for the Iron Condor. The premium volatility increases up to the event, so you're buying inflated premium. You're buying this extra cost built into the trade. When you put this trade on during non-earning season, it wouldn't cost you nearly as much. The downside here is that you're overpaying and you need a bigger move than you probably ordinarily would need in order to profit using a straddle or strangle. That's why the Iron Condor makes more sense. Now, the risk with an Iron Condor is that the stock does put in a big move. It surprises everybody, and you get a ridiculous move over 465 or a ridiculous move down here below 365, and you can start to realize losses. Using an Iron Condor, our losses are capped at 5 points on either side of the trade. But what's more important with the Iron Condor than with the straddle or strangle is with any credit spread, you have, no matter what, the bare minimum before you take in any other factors, you have a 66% chance of being profitable in the trade, of 100% success, right? A credit spread profits in two ways. Credit spread will profit if the stock price is out of the money at the time of expiration. You realize 100% profit on your credit spread. You will also realize 100% profit on your credit spread if the stock price is at the strike price at expiration. The only way you can lose on a credit spread is if the stock price is in the money on your short strikes at expiration, okay? So straddle or strangle, conversely, the only way you can profit on those is if the strike price, if the stock price is in the money when compared to the strike price. So if that confuses you, if options confuse you, and you guys haven't read up on them, whatever, it can be complicated, but the odds of success, if you tell me before I ever take the trade that if you do this, you have a 66% chance of winning, that's a pretty good head start as far as the market's concerned. But it's also why you get a smaller credit. You're trading a $600, $400, $500 stock, and you're getting a 50-cent credit. So there's a reason that you're not being paid for that level of probability. But at the same time, I would trade in base hits over swinging for the fences and trying for the home run. Most of the time, base hits win ball games, not home runs. You take enough swings, eventually you'll get a home run, right? But that should not be your focus every at bat. You just want to see pitches. You want to keep yourself in the game, right? So it's no different here when we're trading around earnings season. So having said that, we'll move on to the next trade here. One of the other ones I want to talk about is LUV. This was an intraday alert that I picked up on a couple of my scanners and news feeds. We saw some large options, large call buying sweeps go through for the November 38 calls. Okay, this thing gapped down after earnings. You see the red E here. This thing was trading at $42. The next day, the earnings are crappy. Shoots down to $37. We get an alert from our scanners and the news sources saying that there's a large options, or a large sweep, call sweep that just went in. Somebody bought 5,300 or almost 5,300 contracts at 80 cents per contract on the ask. What does that mean? Well, it means that somebody put in, 5,300. They bought 5,300 contracts at 80 cents at one time. It's like a big, big market order, right? So if I did that, I'm going to look here and see how much that was worth. Somebody spent $500,000 on that trade at one time. So somebody maybe on the inside, maybe I don't know, maybe they just got really lucky. Somebody bought almost $500,000 worth of options at one time using a big market order, and sure enough, I saw that and I looked at the chart here and I said, gosh, this thing gapped down here to $37. It was trading at the time at $37.30. $37.30 is right. Well, shoot. $37.30 is right about there. So we ended up taking this trade here. I alerted it. I bought some contracts for myself. I said, you know what? I like this. Somebody knows something I don't, because most people with $500,000 aren't just spending that because they're idiots. So maybe there's something going on here, maybe not. But at the time, this stock hadn't traded over $38 or hadn't been close to trading at $38, and that was the strike price. So I said, all we really need here is a little spike, and we can get out of this trade with profit. If anybody follows my options trades, you know that I seek 30 to 50% returns on every single trade I take. This trade was no exception. As soon as I bought this trade at 80 cents, I put an order out to sell half of my position at just about $1, which is roughly 30%. So sure enough, here an hour later, I find here my order. I have a little chime go off on my computer when my order fills. I said, oh gosh, one of my trades filled. I looked, sure enough, my position had filled half. I sold half of my LUV for a 20-cent profit in about an hour. And I said, God, what's going on? What's going on here? I looked at the bid-ask spread, and I noticed that it was trading at almost 40% for my entry price. I said, my goodness, I better put another order out. I'm up 40%. Put another order out. I sold another quarter of my position. A few minutes later, I pull up the LUV chart. I take a look at it, and we see the intraday chart, and it shows. I'll put it up here. Okay, this is what it looks like right here. This blue line represents where we bought LUV, right? And we see the stock start moving up. See here, so I sold on the first spike, I sold a half my position. On the next spike, I sold a quarter of my position. Then we keep getting these spikes. Next thing I know, my position's up 100%, 105%. I sold a little bit more. This thing ran almost 200%. We had traders in our room that took this trade that I alerted, and they locked up almost 200%. That's remarkable, obviously. It's one of what I just said. We don't swing for the fences, but if you take enough swings, eventually you'll hit a home run. This is one of those scenarios. We didn't know the stock was going to move up. Remember, our first target was 30%, just like on every other options trade. We got 30%, but we also got nearly 200%. So I wrote a little blog about this. You guys can go to warriortrading.com and take a look at recent alerts, and you'll see a blog I wrote on this trade. But also chronicling the trade alerts for this particular setup. So this was alerted as a swing trade, ended up being a day trade because we were able to lock up, almost 100 or 100 something percent. Now, obviously, it wasn't my intention to alert a swing trade and day trade it only, but I don't think anybody's going to complain when their swing trade moves, as many hundreds of percent as this did. So it wasn't my intention. I didn't expect this to happen, but again, put ourselves in a position of advantage. Remember, here's the earnings play. Gaps down, right? Sells off. It's trading like nothing all day. Then in the middle of the day, this thing, somebody places a large options order, and then the rest is history. Now, what ended up happening here was the conference call with the CEO. He got on, said some very bullish things for the stock, was very confident in the airline numbers and their projections, and so this thing ended up rallying rather quickly. Also, the catalyst in play there was that somebody placed, a massive order, because once that order was placed, I placed a massive order for myself, and other people placed big orders. So the opportunity that the result that we see here is a result of the opportunity of just being aware of the call sweep in the first place and understanding the potential. Stock that gaps down after earnings, and you see these big bullish bets. Or conversely, if the stock gaps up and you see these big bearish bets, There might be something more to the picture, might be worth a stab. We do know that stocks that make these big moves, these gaps, especially for earnings, like to fill the gaps a high percentage of the time. So there's a lot of factors here to support the trade. Like I said, we were only looking for the 30%, but we ended up getting much more. So good job to everybody who took that. I got a lot of emails. Of course, when we alert a big winner like that, and you're everybody's hero, and that's always a great feeling. So I'm glad everybody got a piece of that. And if you didn't, stick around. There will be other opportunities. This is the stock market. It's a cyclical thing. And once again, for the last time making a baseball reference, base hits win ball games, and every now and then you'll get a home run, and that's what this was. Last trade I want to talk about is on Tesla. It's another earnings Iron Condor. Why do I like trading the earnings Iron Condor? I said it earlier. It's a high probability setup, right? We have a 66% chance of winning no matter what happens to the trade. We have a 66% chance of success before anything else. So that in and of itself is what attracts me to these particular setups. In this case here, we saw the earnings event took place on the 26th, and let's see, the stock gapped up here to this red line. Remember I told you earlier the red line represents the top of the TAS market box, which happens to be an area of resistance. The TAS boxes show us areas of resistance and support. This red box here, this red line shows us that resistance is just under $215. Why is resistance just under $215? I don't know. I didn't pick that spot, but I can tell you the 200 moving average is also right there. That's this yellow line, right? 200 moving average also converging on that same spot. I bet if I go back in time at that same spot, I'll find that it's also an area of significance in previous history. Sure enough, excuse me, let me just draw the blue line here. Right about there. Sure enough, if I go back in time here, I can see that, oh look, back in June of 2016, $215 was an area of significance for the stock because it was an area of support, right? The stock was trading above this area, bounced off it, moved up, bounced off it, moved up, bounced off it. It wasn't until this gap down that it was finally broken to the downside. So this area of previous support became future resistance. Oh, and look, just a few weeks ago, 215 plays a role back here in early October. I could go back in time here, and I bet we'll see, sure enough, look at that, previous support back in March 2016. Previous support at that same exact price, December 14th, 2015. Previous resistance back on October 26th, 2015. Previous support. Guys, we can go back and forth in time here. Look at this again, back here in August 2015. All right? You can see that this area isn't just some arbitrary spot on a chart. It plays a significant role. This is just basic technical analysis. If anybody can draw a straight line connecting dots, then you can do this, all right? This is not rocket science. This is something that every trader should be able to point out to you. And the fact is here, we did an Iron Condor with our short strike at 220, so we had a little bit of cushion here. We needed the stock price to stay under 220. It sure did. And then we had a strike to the downside here at 175, which is off the screen. Obviously, it never even got to that area. This was a great trade, 90%. We sold this particular Iron Condor for a credit of 48 cents, and we bought it back at 5 cents. I had some people ask me, Jeff, why do you buy your trades back at 5 cents? Why don't you let them expire worthless? It's a good question, right? Why would you waste the money and time on commission for 5 cents when a trade is going to expire at the end of that week? Because we always use weekly options for these Iron Condors. Why would we buy it back, and waste the time and the money on that? Because clearly, it would have expired worthless. It would have been 100% winner. I would have kept 100% of the premium. Well, I'll tell you why. Because the one time that I didn't do that was when the stock was halted on a Friday afternoon, an hour before the market closed, and it was halted on news, right? The stock opened up just before the market closed, some 40 points higher, and my options that I had looking at a 100% winner on ended up becoming a max loss loser, and I lost a lot of money on it. what was a sure thing. It was an absolute winner. There's no way it could have happened, but sure enough it did. So you got to be careful. Stocks trading around earnings seasons are going to be prone to a lot of analyst upgrades, downgrades. They're going to be prone to a lot of press releases. Investors, board members, CEOs are going to be trying to impress investors, and it's going to be a lot of volatility during those weeks. That's why we see implied volatility rising during earnings weeks, earnings periods. So why do I buy it back for 5 cents? To mitigate the risk. Is that extra $5 that I would have kept on that options trade, is that $5 worth it? Worth the risk of losing everything on the trade? To me, it's not. So you could have kept that trade open, and in most cases, it's not going to get halted and move 40 points to your max loss. Probably in most cases it won't. But in my experience, and because I want to be around doing this for a long time, I don't care about the $5 more than I do keeping the 43 cents that I made, or the $43 that I made. So per contract. So understand it's a risk management technique. You don't have to buy it back. But if you don't buy it back, you're leaving that exposed until the bitter end. And if something like that happens to you, then you're going to not only give up everything you made on the trade, but you're also going to be out some money too. So something to keep in mind. You don't have to do it, but if you understand how risk management works and why $5 is not worth giving up $43, then I can't help you. So those are the trades from the week. Once again, Apple, McDonald's, Caterpillar, Visa, Chipotle Mexican Grill, LUV, Southwest Airlines, and Tesla. And we have one more. We'll go over this one right now. This is NEE, NEE. NEE is Nextera Energy. All right, this trade was a bull call spread. I was looking for a breakout here over the top of 125. I wanted to see a move toward this 130 area, 129. We did get a move up on day one. Day two of the trade, we sold. You can see here, I'll just draw little arrows for you guys. We bought in the trade on this day here as it tested this resistance at 125. The next day in the trade, we got to move up. We're within 10% of selling this position. We got to a 20% winner. My order was open for 30%. We did not get there. Of course, the very next day, the market is soft. Everything moves down, and this thing sells off, gives up all our gains. Then today, the market was flat, but the stock was up. Probably in some part due to shorts covering for earnings that are coming up Monday. I closed this position today. NEE was only good for an 8% winner. 8%, not a big winner, but nonetheless, we made money on the trade. We had good opportunity here. It was a good setup. We just did not get the follow through to 129 that I was looking for. But earnings are Monday morning, so obviously I'm not trading a long bias strategy during earnings. If I were going to trade a earnings strategy, what would it be? It would be an Iron Condor, like we talked about. So that's NEE, and that concludes the trade. It was the trades from the week. It was a very active week for us. We did well, 100% success. Very happy with how the month of October has been. October historically has been my best month trading. This month I've had, 3 losers on the month and 18 winners. So I think the statistics speak for themselves. It was a very good month, and that continues to be the case. So moving into the fall winter here with November, December, we got the Santa rally coming up. Looking forward to finishing out earnings season. We have a couple more names coming up next week, Facebook and some others. Once earnings season is done, that's great. Then we can get back to normal trading. But right now we're going to stay focused on Iron Condors for just a little bit longer. Again, if you guys are watching this back or watching this playback, you can email me, jeff@warriortrading.com, if I did not answer your questions. And lastly, I apologize again for my voice. I'm getting over sickness here, so hopefully by next week I'll be good to go. I hope everybody has a great, safe weekend, and we'll be back at it Monday. Take care.